Hey everyone, and welcome to This Explainer. Normally when we see complex global tensions bubbling up, investors immediately stampede toward the ultimate safe haven, gold. But today, we're unpacking a really fascinating paradox. Right now, despite some incredibly intense times globally, safe haven gold is actually dropping. And what's truly wild is that this massive market chain reaction didn't even start with a geopolitical event. Nope, it started with a single, completely unexpected domestic data point right here in the US. So today, we are going to decode exactly how one economic release triggered a massive shockwave that rippled all the way out to global precious metal prices.
Okay, let's dive into our roadmap for today. We're going to start with the jobs report shockwave, track its impact on yields and the dollar, and then weigh that against the geopolitical buffer. After that, we'll map out the specific technical targets for gold, and finally, wrap up with silver's technical setup. All right, part 1, the jobs report shockwave. And wow, was it a massive beat in May?
Every great chain reaction needs an inciting incident, right? Well, for the financial markets recently, it was a completely unexpected shock to the US labor market. Get a load of this number. 172,000, that is the massive number of jobs added by US employers in the month of May. It's honestly a staggering figure. It tells us the economy is running significantly hotter than almost anyone anticipated, especially when you consider the unemployment rate held perfectly steady at 4.3%.
To really put this into perspective, you have to compare the reality to what people were expecting. The consensus estimate across economists was a mere 80,000 jobs. The market had completely priced in a cooling economy. Investors genuinely thought things were slowing down. Instead, the reality of 172,000 was more than double the consensus estimate. This wasn't just a beat, it was an absolute, literal demolition of expectations.
Now, to understand why this matters so much to gold, we've got to demystify a crucial bit of market jargon, the rate cut trade. Basically, this is an investment strategy where traders buy up assets, like gold and equities, because they're banking on the central bank lowering interest rates to rescue a cooling economy. Lower rates mean cheaper money, which is typically fantastic for growth stocks and great for gold, since gold doesn't pay a yield. But when a jobs report comes in at 172,000, it instantly crushes that soft landing relief trade. I mean, the central bank doesn't need to cut rates to save an economy that's casually adding that many jobs. And when that rate cut trade gets crushed, the ripple effects begin.
Which brings us to Chapter 2, yields and the dollar. The dominoes fall across the markets.
So we're tracking the first ripples as they slam into the broader financial markets. The dominoes are officially falling. This is the immediate mechanical reaction of the market waking up and realizing interest rates are going to stay higher for longer. With rate cut hopes completely dashed, bond yields had to climb to reflect reality, sending the benchmark 10-year Treasury yield up near 4.5%. And you know how it goes. When yields rise like that in the US, foreign capital rushes in, which strengthens and firms up the US dollar index. Traditionally, a stronger dollar and higher borrowing costs act like heavy gravity for stocks, causing US equity futures to retreat.
But here's the thing. It wasn't just a uniform panic across the board. We actually saw a really fascinating split close on Thursday. The Dow Jones Industrial Average literally surged 1.7% to a record high of over 51,500. The broader S&P 500 managed a 0.4% gain. But then, check out the NASDAQ Composite, which actually slipped 0.1%. Why the split? Well, capital was violently rotating out of heavily weighted AI-linked tech stocks that absolutely rely on cheap money and moving into other sectors. It's a massive shift.
So, higher yields and a firmer US dollar? That is absolute kryptonite for precious metals. Gold doesn't pay interest, so when Treasury yields hit 4.5%, the opportunity cost of holding gold is super high. Plus, gold is priced in dollars, so a stronger dollar makes it way more expensive for foreign buyers. Given these massive, crushing economic pressures, we really have to ask what on earth is keeping gold from just going into a total freefall right now?
That leads us into Chapter 3, the geopolitical buffer, a very delicate balance in the Middle East.
The answer is that while domestic economic data is dragging gold down, a delicate balance in the Middle East, specifically around the Strait of Hormuz, is providing a critical floor. Right now, this geopolitical risk is acting as a buffer, but it's contained. We've actually observed a 9-week ceasefire in the region. This pause has allowed shipping flows to gradually resume, which is exactly why energy prices haven't skyrocketed. Brent crude is being contained nicely below $100 a barrel, trading near $94.67, while WTI crude sits around $92.41. The Hormuz situation remains a volatility premium in crude, an inflation risk input for treasuries, and crucially, a baseline support for safe haven demand. But, and this is a big but, only as long as the market fears that ceasefire narrative could deteriorate.
Think of it like this intense, high-stakes tug of war. On one side, you've got this massive macro drag. The surprise jobs report created higher yields, a firm dollar, and fears that oil-linked inflation will stay higher for longer. That entire side is yanking gold prices down. But on the exact opposite side, you have the geopolitical buffer. The residual fear that the Middle East ceasefire could break down creates just enough safe haven demand to pull gold right back up. Gold is precariously trapped right in the middle of these two titanic forces.
All right, part 4, gold bull versus bear targets. Let's map out the technicals.
Because gold is caught in this intense tug-of-war, the technical levels are absolutely crucial right now. Spot gold is currently feeling the squeeze, trading down slightly by 0.24%, near $4,464.60 an ounce. So, let's see exactly where the battle lines are drawn. For the gold bulls to prove they're winning, their very first immediate obstacle is pushing prices back above resistance at $4,481.78. If they can sustain a move above that, their next target is the 50-day moving average, sitting way up at $4,630.16. However, if that macro drag wins out, the bears have a clear downside objective. They want to break support below the critical 200-day moving average at $4,428.44. Man, if that floor gives way, things could accelerate downward incredibly fast, down to $4,366.23 and potentially a steep drop all the way to $4,099.12.
Finally, Chapter 5, Silver's Technical Setup, Tracking the Downside Momentum. We definitely can't forget about silver. It often acts like gold's much more volatile sibling, and today is absolutely no exception. It's feeling a slightly harder hit from the macro drag, currently trading down 0.77% at $73.320. Tracking its downside momentum, the bulls desperately need to drive prices back above a specific zone, between $74.10 and $74.45 to regain any kind of control. If they clear that, they can target $75.50 and eventually $78, but pay super close attention to the bear scenario here. The absolute key danger zone is a break below the $72 to $71.80 area. That's a critical Fibonacci extension level. If silver falls through that technical trapdoor, the bears have a crystal clear path to drive targets down to $70 and then straight to $68.
So we've seen how a single domestic jobs report can completely upend everything, sending yields soaring and punishing the rate cut trade. But we've also seen how a delicate geopolitical ceasefire is acting as the literal safety net,